Hi, welcome to this chapter of a newbie guide to REITs analysis. And this chapter will look at financial statements and how to understand them. So for this chapter, we'll use this example of a balance sheet of a REIT for the year ending 2022. So you can see that the REIT has basically raised equity from unit holders. In this case, it's over here, represented by unit holders funds, and it's raised around $10 billion of equity from unit holders. It has also raised around $300 million of equity from perps, so perpetual holders. So for my case, I consider equity raised from perps to be quasi-equity, so which is a bit different from the full accounting understanding of it. So accounting-wise, most of the perps are considered as a full equity, but I tend to disagree. I think perps are more like quasi-equity, something of a mezzanine structure between that of equity and debt. So I think the conservative investor should be better off considering perps as a quasi-equity. Whether it's 50-50 or 60-40 or 70-30, it's up to you. But it's probably more conservative to think of it that ways. In any case, the total capital raised from equity would be $10.3 billion in this case. And the REIT has of course raised capital through debt. You see over here MTN and term loans from the banks. In total liabilities will be $7.6 billion. And so you take the total capital raise to buy total assets of $17.9 billion, and that's represented by the asset side of the balance sheet. The asset side of a balance sheet for the REIT is actually quite easy to understand because it's mostly just cash. In this case, $217 million, and the rest of it is actually just properties in one form or another. After all, that's what a REIT does, right? It raises capital to buy properties, collects rental, and then pays off a bunch of net expenses and stuff. And the remaining distributable income will just appear as DPU to the unit holders. So the asset side of a balance sheet of a REIT is mostly just properties in some form of another. Mostly for the REIT, you have investment properties that they own more than 50% of it and therefore it is consolidated into the balance sheet. Therefore, in this case, you can see that $16.4 billion of investment properties lie on the asset side of the balance sheet. You also have investment properties under development because REITs are allowed to have a certain percentage of the properties under development rather than fully developed and income generating. You also have two other items which are JV and associates. So if you have a property and you have less than 50% of it, it's either going to be a JV or an associate. So and JV will appear when the REIT has significant control over the entity holding the property. And if the REIT has a lesser percentage holding of that entity to the point that it doesn't exert significant control over the entity, then it will be considered as an associate. So for this REIT, you can see that there's just a bit of JVs of less than 1 million and around $17 million of associates. So how much associates and JVs the REIT has really depends on the REIT concern, and therefore the conservative investor we quite well advised to look through the asset side of the balance sheet and scrutinize what it has and what it has not. So always remember the golden rule for investment, to underestimate the true valuation of the assets and overestimate the valuation of the liabilities. Because what we have is a common case where a lot of REITs, especially with scrupulous managers, they overinflate the assets of the balance sheet and understate the liabilities that they hold. So while the conservative investor is advised to scrutinize the entire balance sheet and make sure you're satisfied with the quality of the assets that they own. Next, we come to the income statement for a REIT. The income statement is quite similar to what you find in other companies. So mostly you start with the revenues, and then you minus away the service fees, the taxes, and other operating fees like utilities, manpower, and so on and so forth. And you end up with NPI or net property income. After that, you minus away the management fees, the finance cost, which is basically the interest on the debt they pay. and then the FX differences, and then you end up with a net income. And then after that, you have to add in the non-cash accounting items. So, for example, changes in the fair values of the derivatives that you hold, and of course, the investment properties valuations change year to year, subject to many factors. And that after that, you end up with the final waterfall of the total return for the year. So you can see that over here you have the EPS, which is quite easily understood by most investors. But for in the case of the REIT, you have something also quite interesting, which is the DPU, which is something that is of most concern to unit holders, because this represents the amount of total cash that the unit holders hold are gonna earn for the year. So you can see that for this case, the EPS differs from the DPU, and in general, the EPS will always differ from the DPU. So the magical question is then, what's the difference between the EPS and DPU? I think the most basic answer to give is that the EPS will concern a lot of non-cash accounting items, whereas the DPU is mostly a matter concerned with the true total cash generated or outflow. So EPS concerns involves a lot of non-cash accounting items, mostly over here actually, and the DPU is mostly concerned with the cash items, which really matters to the unit holders, which affects the total cash and dividend handouts they're going to receive. So note that in this case, we have an EPS of 17.9 cents, and then the DPU is 15.8 cents. So how do we reconcile the difference between the two? So in the financial statements, you can normally find there's a distribution adjustments coming in. It really depends on how the REIT presents its financial statements, but in general, you can find it in one of the footnotes on the financial statements. You can see that in this case, the total distribution adjustments is $268 million, which will then translate into the difference between the DPU and the EPS that you see earlier. You can see that the difference between the EPS over here and then the DPU over here will mostly be non-cash items. If you look at it, it's the mostly from the fair value changes. In first of all, the financial derivatives. So for a REIT, normally it employs interest rate swaps or IRSs or FX hedges if it has operations overseas. So all this stuff and the derivatives are subject to MTM changes on a yearly basis. And as all this stuff are not non-cash in nature, it needs to be reversed out to derive at the DPU. Similarly, for the investment properties, be it under development or fully completed, all this stuff will have valuation changes year to year, so you need to adjust for it again. And also for the fair value changes for the properties in the subsidiaries, in the JV, and in the associates, all that stuff will have to be reversed out as well. So you can see that in the case of this REIT, of the $268 million of adjustments they've done for the year, the majority of it is just for properties actually, and of course for the financial derivatives. You also have deferred tax expenses that have to be reversed out, because there's a difference between the accounting tax expenses and the actual cash paid out for taxes. And of course, if you're a tax expert, you can understand this quite readily. But there's normally some tax adjustments that need to be done. There's also something else, which is the management fees paid that is commonly employed by REIT managers. So what happens is this: if the manager takes 100% of the fees in cash, then all of it will not be available as distribution to the unit holders. But if the manager chooses to take a certain percentage of the fees in a unit, then the money that is saved for this payment can then be distributed to the DPUs and therefore boost the DPUs for that period. But the flip side is, of course, that if the manager takes the fee in units, then the unit base will rise in the next period, and therefore the DPU for that period will then drop unless the distributable income rises for the subsequent period. So it's a bit of a trade-off when the manager elects to do this, that is to take the management fee partially in units. So you get a bigger DPU this time round, but potentially a lower DPU the next round. So these are the in general the kind of adjustments that needs to be performed when one does a reconciliation between EPS and DPU. Something else that affects the DPU will be the capital distributions, which is very common actually. So there are many forms of capital distributions which are not uh, distributions from the operations. So first of all will be gains from sales and FX. So if a manager buys a property and subsequently sells the property for higher price, so there's a capital gain, right? And this gain can then be distributed to the unit holders via capital. And as this cash is not generated through operations, it will be considered as a capital distribution. You can also do likewise for FX and so on and so forth. So if they realize a profit from the FX hedges from favorable movements, then that gain is capital in nature and can also be distributed to unit holders. But of course, a lot of these gains are one-off and therefore not sustainable. You also have coupons and interest. So for example, something which is quite common nowadays would be to buy assets that comes with a coupon. So for example, in this case, you have this REIT called Capital DC REIT. It involves purchasing of network assets, and therefore, when they buy this network asset, they actually bought the perpetual bonds for this asset, and therefore they get a coupon payment every single year. So this coupon payment is not really operational rental income, right? But nonetheless, it's a coupon that they earn every year, and therefore can be distributed out as a capital distribution. You also have interest income for the REIT. So for example, they've done in this case, this REIT called the FLCT has done a forward purchase of an asset. So this asset will be under development, and this REIT has forward funded this development. So for the period of the development which will come out to be a couple of years, the REIT will again receive interest payment on the capital that they use to forward fund the development initially. So this interest payment is again not operational income, right? But yet the REIT is able to distribute out the interest payment as a capital distribution. So for a conservative investor, you can see that although the DPU is just one number, but it comprises of many different parts, right? It comprises of the operational income. It comprises of capital distributions which might come from here, here. And for the operational income, you can also see the amount of adjustments that need to be done to derive the DPU from the EPS. So I think for a conservative investor, would be well advised to look at not just the DPU on a headline basis, but really to scrutinize the DPU to see how much of it is a one-off in nature and how much of it is artificial boosting of the DPU, and how much of it is actually sustainable, and how much potential DPU increment or decrement is to come in the following years.